Yeah, hello everybody. Now let's start with something new, a chapter on withdrawals and similar transactions or events. You see here what our program for this chapter is supposed to be. We are at the moment completely at the beginning, so let's begin with why a special rule for withdrawals or a solution for withdrawals is necessary in value-added tax. Why is it necessary is our question. So let's look what happens in the course of time. Um, then you will understand what's the problem here. First, imagine a trader sells some good, let's say a TV set, for 1,000 plus VAT to our enterprise, to trader B. Then it is sold at 1190. And however, now when the TV screen comes to the enterprise, input tax is refunded because here an acquisition has been made for the enterprise. And then you can claim input tax refund or deduction. So the asset stands around there now for a net value and is until now completely untaxed. Again, at a later point of time, B, the entrepreneur, now decides to withdraw the asset into his private sphere. So that means, hop, there it goes. Now the asset is still untaxed. That would mean private consume could be made without paying taxes, whereas every normal consumer would have to pay VAT on what is private consume. An entrepreneur would be able to use his own stuff for his private consume without taxation. That would be unfair. So private consume should be taxed. Now, how do we have a legal basis to tax private consume? Let's analyze 3.1. Is it possible to apply 3.1 or 1.1 number 1? So first, is this a delivery? A delivery is defined as transfer of the position of an owner. However, who is the owner previously? That's the trader B, and afterwards the trader is still the owner because it's the same person. It was just shifted from the entrepreneurial sphere to the private sphere, or the sphere outside the enterprise, as the law defines it in a more exact way. So we don't have a change of owner. So one of the conditions for 3.1 is not fulfilled, so we cannot apply this. And there is even a second flaw if we want to apply 1.1 number 1. 1.1 number 1 requires that the transaction should have been for consideration. And this is also not the case. B cannot pay something to himself or cannot give something in return to himself. That's absolutely impossible. So we have two problems when we think of applying the standard rules. We have first, no delivery, and second, no consideration. So that would mean either we have to create special rules or our rule system breaks down, because then everybody in the population would try to register an enterprise, buy, consume stuff first for his enterprise, then after a while resign and say, I don't get that sold, so I take it over to my private sphere and use it myself. And so every clever guy in the population and every would have untaxed consume, and after a while the less clever guys would at least know the clever guys, get the tip, and that's it. So what can the law do to close the loophole or the gap? Well, you could either set up completely new rules for withdrawals, or you could simply make a trick. The two things which do not work here is the missing delivery and the missing consideration. So you could just write down a rule which says, well, in case of a withdrawal, okay, I know that's not a delivery. However, everybody has to do as if it were a delivery. We just see it by fiction as a delivery. And well, then it's still not for consideration. We don't care. We just write a special law. Well, the withdrawal is deemed to be for consideration. So you find such a rule indeed in paragraph 3.1b. Do as if it were a delivery and do as if it were consideration. Then now we can apply our standard rules, because when you now look to 1.1 number 1, the matter becomes very simple. Is the acting person an entrepreneur? Yes, certainly. Is that within the scope of the enterprise? Yes, certainly, because here is an asset which is part of the enterprise property and is now withdrawn, and that it is a part of the enterprise property is sufficient to say it has to do with the enterprise. That is sufficient to bring it into the scope of the enterprise activities. Is it for consideration? The standard answer would be no, nothing is paid. Is it a delivery? And the usual answer would be no, ownership doesn't change. And is the place of delivery? Well, 3.6 or 3.7 as usual. However, now the trick comes. Forget about these bold printed answers and replace them by the fiction. This is to be seen as a delivery and this is for consideration. We don't care about reality. We just close the loophole by a fiction, and surprise, the usual rule can be applied to a withdrawal just as in all other cases. So the withdrawal is now taxable under the standard rules of 1.1 number 1. Everybody is happy. We have solved the problem in a very economic manner. We didn't need an extra rule. We just closed the loophole or the gap in the two elements of 1.1 number 1, which did not work here. And then we can go on as in all other cases. That's a nice trick of the legislator, a nice legislative solution. One element of the taxability, one element of the conditions is missing, and you just add a fiction. Well, it's not missing, it's fulfilled. Then everything goes on as usual. A similar problem will arise if you don't take things out of the enterprise for private purposes or for other purposes outside the enterprise sphere. But if you hand over things to your employees for their personal use, so for their consume. Because there it can also happen that you are generous to your employees, you give them something basically for free. Now that would be, again, well, it would be a delivery. However, it would be not for consideration. And again, we would have the possibility of untaxed consume. That's again massive unfairness. And so we have to close that gap. Yeah? The fiction of 3.1b also applies to this constellation, because the fiction says it is deemed to be a delivery for consideration if one of the following cases arises. First, the entrepreneur takes something out of the enterprise and uses it for purposes outside the enterprise, so mainly for private consume, but might be also for other imaginable purposes outside the enterprise activity. Second, the entrepreneur gives goods for employees or their family members or relatives for free for their personal usage. Then, okay, we could say there is a delivery because ownership indeed changes, but it would not be for consideration. And the fiction of 3.1b says no. I just say it's for consideration. Reality doesn't matter anymore, so we can again check One number one, say all the 5 conditions are either genuinely fulfilled or are deemed to be fulfilled, and one number one can apply. Everything's fine. Untaxed consume of personnel is no longer possible. Just to be on the safe side, the law then adds a third alternative. Any other case where an entrepreneur gives away a good without consideration, so absolutely for free, then also this rule applies, because yeah, basically it would be possible that an entrepreneur also hands over goods to unrelated other persons without consideration, for which he had previously got input tax deduction. So we would have the risk of untaxed consume of a good, and that must not happen. That would be unfair to all those people in the population who pay their VAT on their consume. So also for reasons of prudence, that loophole must be closed. So you have the third alternative in 3(1)(b). Also, every untaxed consume, every untaxed giving away of, or every giving away of a good to anybody outside the enterprise without consideration is automatically deemed as a delivery for consideration, so that it can trigger taxation. So after we have set up this list, we can basically tax everything, even if it's not a delivery, or even if it's not for consideration, it's deemed to be. And this way, untaxed consume is prevented, and an enormous loophole in the law has been closed. The only exception which the law makes is if you have some giveaways as samples or gifts of small value. That does not trigger taxation. That's rather more seen as a marketing expense for business reasons. And well, that would really make things a bit complicated. The idea is if somebody gives you some chewing gum for free as a marketing gift or marketing activity, that does not count. Or if somebody gives you a pen for free with some marketing slogan on top, nobody cares about that. But if somebody gives you a car for free, or a video recorder for free, by the way, a video recorder is a bit outdated as an example. You would probably even buy it for free. However, if somebody gives you some valuable part for free, that would trigger 3(1)(b), the withdrawal taxation. The same, by the way, can be found on the EU level. The EU Value-Added Tax Directive plays exactly the same trick with fictions for the withdrawal problem. It says in Article 16, paragraph 1, the application by a taxable person of goods forming part of his business assets for his private use or for that of his staff, or their disposal free of charge, or more generally their application for purposes other than those of his business, shall be treated as a supply of goods, so as a delivery for consideration. Here you have exactly the same fiction in a bit more strange wording. Yeah. However, here's the exception. The application of goods for business use as samples or as goods of small value shall not be treated as a supply of goods for consideration, because naturally EU law is binding. So if we only had the command of 16(1), we would be forced to tax everything, even a small package of chewing gum, which you get for free for marketing purposes. So we need the exception in 16(2), that we are allowed to leave these small little gifts which you get from an enterprise for free untaxed. Okay. So, we still have the one or other problem, because there might be a particular situation where our withdrawal taxation does not lead to a reasonable outcome which would convince us. Imagine we have somebody who buys a new car, and that somebody is, as you see here in the middle, an insurance agent. So he buys a new car for 4,000 plus 600 a value-added tax. Yeah, right, 90%. And the insurance agent now gets no input tax deduction. So this car is now in the business property, however, it's still fully taxed. If you now take the car out of the enterprise and move it to the private sphere, you do not have the risk of any untaxed consume. So if we tax the withdrawal here as a delivery for consideration at the, let's say, present market value, we would have a double taxation, and that must never happen. So we need something to avoid that risk. What can we do? Well, the rules of the national rule in the VAT Act say 3.1b, the fictions that something is a delivery and for consideration are only to be applied if the good in question has entitled to input tax deduction, or if at least parts of it had entitled to input tax deduction. That is the second sentence in paragraph 3.1b. Again, you find exactly the same in Article 16 of the VAT System Directive. Here the red letters, there's a condition added to 16.1. 16.1 only applies where the VAT on these goods or on the component parts thereof was wholly or partly deductible. Because if it were partly deductible, then you have a partly untaxed car or a partly untaxed asset, and then you still would have the risk of untaxed consumer. Yeah, so that's what you'll find in the VAT directive, and here that's the full wording. Now, yeah, now the red sentence was added, and now you have it in full. Okay, so if the rule is now that the withdrawal is taxable if the good or parts of it have entitled to input tax deduction, then it was nearly foreseeable that there would be a debate how that has to be interpreted in cases where parts entitled to input tax deduction, and it was foreseeable that sooner or later extreme cases would happen and would go to court. And indeed, what happened in history actually happened is somebody buys a car without any right to deduct VAT from the price, for example, from a private first owner, or he bought it for himself as a private person and later opened an enterprise, or what else. So no right to VAT deduction at all. So the price of the car 30,000, it's then within the enterprise. Now still fully taxed. However, during the car time when the car belongs to the business, the one or other part has to be repaired or replaced. And what indeed happens here is a single windscreen wiper is exchanged. One single windscreen wiper. Imagine the price is 20 euro plus 380. Again, I don't have any idea what the price really had been or what the windscreen wiper today would cost. I just needed a number. So please don't be enraged that I don't know the prices. However, this windscreen wiper now entitles our entrepreneur to input tax deduction because he runs an enterprise which has taxable and liable output, so everything he buys for the enterprise properties entitles him to our input tax deduction. So now later, at a later point of time, he withdraws the car from the enterprise to the private sphere. Let's imagine the value of the car is then still 28,000. Now a tax inspector comes to nice ideas, because at least one small little part of that car has now entitled to input tax deduction. It does not even matter if the input tax was claimed. The decisive thing, it would have been possible. No? So what happens next? The fiscal administration comes to the genuine conclusion that the law says the withdrawal of a car is taxable as a whole if a part of the car has entitled to input tax deduction. We have a part, that the windscreen wiper, and so they charge VAT on the whole withdrawal value of the complete car. That definitively does not meet the humor or the sense of humor of the taxpayer. That can be understood. So everybody is a bit puzzled, and everybody asks themselves, can that be okay? And indeed, such a consequence seems a bit exaggerated, unjustified. So taxpayer complained to the fiscal court. Fiscal court said this is a matter of European Union law. We are bound to follow the European Union's directive that says if a part of the car entitled to the VAT deduction, then the withdrawal is taxable. However, we don't know if it's really meant this way. We asked the European Court of Justice, because for European Union law, it is the European Court of Justice which has the monopoly for a definitive interpretation in all cases of doubt. That was the famous windscreen wiper case, which actually happened, however, perhaps with different figures or prices. It was indeed only a windscreen wiper. So the European Court of Justice now decides, in cases where only a part of the good entitled to an input tax deduction, the wording seems to be a bit strange, and it must be reasonably interpreted in a way that only these parts will then be subjected to withdrawal taxation. And further, that in cases where such parts only replaced identical parts which has been used up for entrepreneurial purposes and had been bought without input tax deduction, then it's the most adequate solution to say that not even such parts can be subjected to withdrawal taxation, because here the input tax drawn just replaces or is a just compensation for the fact that in the original part there was the VAT contained, which the entrepreneur never could claim as refund. So this is not an unjustified double taxation. So basically they said only those parts which have been added to the object in question and entitled to input tax deduction can be subjected to withdrawal. Then this indeed is an interpretation which leads to systematically convincing results. So here the wording is a bit inadequate, misleading, and interpretation says we need to rectify this by using some brain and knowledge of the system, and interpret the wording as meaning what must be meant. Well, by the way, we have a similar problem if a good, which was a similar problem like in case of the insurance agent, if somebody does not withdraw a car or another asset to the private sphere, but sells it. Imagine if an insurance agent buys a car or something like that and doesn't withdraw it, then the car is still fully taxed. When the insurance agent then sells this car to somebody else, this is a delivery for consideration, triggers taxability. But to levy tax now would mean the car is still fully taxed from the moment when it was acquired at the original market price. And then it's again taxed So twice without that ever input tax deduction has been granted. In order to rectify this, the law then says we need to amend that. And as we can't deny that taxability is indeed given, we solve the problem by declaring this output then as tax-free. For number 28 says, if a good is sold which never entitled to any input tax deduction, then selling this good is tax-free. This, by the way, is also, this fits into the system. It even needs to be, because tell the insurance agent, if there is no for number 28, how could the insurance agent then avoid taxation? Well, he would first withdraw the car to his private sphere, drive it as private car for 2 months, and then sell it in his quality as a private person. So levying or raising a claim on for tax in case where it's not withdrawn and then sold but directly sold would be senseless here. It could be easily avoided by clever persons, and such an exemption necessarily fits into the system. However, here again the dangerous condition that the asset in question must not have entitled to input tax deduction either wholly or in part. The value-added tax directive naturally has the same rule, this time in Article 136, where exemptions are listed. There we find one rule which says the member states shall exempt the following transactions, and letter A is the supply of goods, so the delivery, which were used solely for an activity which is exempted under the Articles 132, 135, 371, 375, 376, 377, and so on, if those goods have not given rise to deductibility. Have a look that this requires that you have a close list of exemptions. So if you sell something which was listed there, then you would have a problem. But we have another article clarifying that the supply of goods which did not give rise to VAT deduction at the moment of acquisition is also tax-free. However, a clarification that in cases like the windscreen wiper case, a part of the good has entitled to input tax deduction, that then the tax liability should be restricted to those parts, and the exemption would still apply for all of the remaining parts is still missing. Probably cases like these will not go to court, because in such a case a clever tax advisor would always recommend to the insurance agent or to the broker or whoever it is to first withdraw the car or whatever it is to the private sphere, use it there for a time. So to profit from the generous rule that withdrawals are only taxed for those parts which are entitled to input tax deduction, and then later sell the good out of the private sphere, that would simplify things greatly. And that probably is a reason why you will have no quarrels, no disputes about things like that ending up in courts. Okay, that is enough for the first introduction. I thank you for listening, and I'm glad to see you soon back on the channel. Thanks and goodbye. Till next time.